From 0 to £50,000 rental income. The ultimate BRRRR strategy 2026. £50,000 in annual rental income. That is not a fantasy figure reserved for property moguls with inherited wealth or 100 years of experience. It is an achievable, documented outcome for ordinary investors who apply the right system, in the right markets, with the right discipline. And today, I am going to show you exactly how to get there using the BRRRR strategy updated for the realities of the 2026 property landscape. If you have been watching this channel for any length of time, you already know that the UK property market rewards patience and precision over speculation and luck. But what separates the investors who accumulate 10, 15, 20 units from those still stuck on their first is not luck. It is a repeatable process. BRRRR. Buy, refurbish, rent, refinance, repeat, is that process. And when you layer HMO yields on top of it, the numbers become genuinely compelling. By the end of this video, you will understand what the BRRRR strategy actually means in practical terms in 2026. How HMO conversions can dramatically accelerate your income journey, what the current data says about yields and refinancing conditions, the step-by-step framework for executing your first or next deal, and the real risks you absolutely must account for. Stay with me, because this is one of the most important videos we have published this year. Let us start with the fundamentals, because there are a lot of misconceptions floating around about what BRRRR actually is and what it is not. Buy, refurbish, rent, refinance, repeat. At its core, BRRRR is a recycling strategy. The goal is to deploy capital into a distressed or undervalued property, add value through refurbishment, generate rental income, and then refinance at the new higher valuation, pulling out most or all of your original cash so it can be deployed again. Done correctly, it allows you to scale a portfolio with a finite pot of money rather than requiring fresh capital for every single acquisition. Now, the standard BRRRR model applied to a single let property, one tenant, one monthly rent, works perfectly well. But here is where most investors leave significant money on the table. When you apply the BRRRR strategy to HMO conversions, the yield transformation is dramatic. An HMO, or house in multiple occupation, is a property rented to 3 or more unrelated tenants who share communal facilities. A 3-bedroom terraced house in the East Midlands, let us say Nottingham or Derby, might achieve a single let gross yield of 5 to 6%. Converted to a 6-bedroom HMO with shared kitchen and living space, that same building could generate a gross yield of 12 to 16%. We are talking about doubling or tripling the income from the same bricks and mortar. In 2026, the average room rate in a well-managed HMO sits between £450 and £750 per calendar month depending on location, room size, and the standard of finish. In commuter belt towns outside London, think Luton, Slough, Reading, rooms at £650 to £750 are entirely achievable with bills included. In northern cities like Sheffield, Leeds, and Manchester, high-quality professional HMOs are commanding £500 to £600 per room. These are not projections. These are market rates we see transacting right now. So the fundamental logic of our £50,000 income target is this. If your average HMO generates £7,000 per year in net income after all costs, you need approximately 7 to 8 well-performing HMOs to hit that target. That is a portfolio you can realistically build over 5 to 7 years using the BRRRR recycling method, even starting from a relatively modest deposit base. Let us look at what the market is actually telling us right now, because context matters enormously. UK house prices at the start of 2026 have stabilized following the corrections of 2023 and 2024. According to the nationwide house price index, annual price growth has returned to a modest 2 to 3% nationally, with Northern England and the Midlands outperforming London and the South East for yield-focused investors. This matters for the BRRRR model because we need the refinance valuation to hold firm after refurbishment. Mortgage rates for limited company buy-to-let products, and you should almost certainly be operating through a limited company structure in 2026 for tax efficiency, have settled in the 5 to 6% range for 5-year fixed products, higher than the record lows of 2021. Yes, but entirely workable when your gross yield is 12 to 15%. Here is a worked example. You purchase a tired, 4-bedroom end of terrace property in a city like Stoke-on-Trent or Doncaster. Purchase price, £110,000. You put in £35,000 to convert it to a 6-bedroom HMO. New kitchens, bathrooms, fire safety compliance, individual room locks, furniture. Your all-in cost including purchase costs and stamp duty is approximately £155,000. Post-refurbishment, the property is valued by a specialist HMO surveyor at £190,000 to £200,000. You refinance at 75% loan to value, a standard product for HMOs through specialist lenders like Precise, Foundation Home Loans, or Paragon. That gives you a mortgage of £142,500. You have recycled all but £12,000 to £15,000 of your original investment. The property generates room rents totaling £3,000 per month gross. After mortgage interest, management fees, maintenance reserves, licensing costs, and insurance, your net monthly income is approximately £600 to £700. That is roughly £7,000 to £8,000 per year from one HMO, with the majority of your capital freed for the next deal. Repeat that cycle 7 times, and you are at £50,000. Let us move to execution, because a strategy without implementation is just theory. Step 1 is capital preparation. You need a meaningful starting pot. For HMO BRRRR in 2026, that means a minimum of £60,000 to £70,000 in accessible capital to cover the purchase deposit, refurbishment, and holding costs on your first deal while you await refinance. If you are not there yet, this is your primary mission, whether through savings, joint ventures, bridging finance, or equity release from an existing property. Step 2 is location selection. You are looking for 3 things simultaneously: affordable purchase prices, strong room rental demand, and a local licensing landscape you can navigate. The best BRRRR HMO markets right now are secondary cities and large towns with universities, hospitals, or major employers. Coventry, Hull, Sunderland, Wolverhampton, and Preston all offer the right combination of low entry costs and genuine occupancy demand from young professionals and key workers. Step 3 is deal sourcing. The best BRRRR properties rarely appear on Rightmove at full market value. You need to be working with local estate agents who specialize in probate and vacant properties, attending property auctions, and building relationships with landlords looking to exit. Off-market and tired properties are your goldmine. Step 4 is assembling your team. Your success in BRRRR is almost entirely dependent on the quality of your contractor, your HMO specialist mortgage broker, and your managing agent. These are not roles you can fill cheaply or carelessly. A poor contractor will blow your budget and your timeline. An inexperienced broker will put you in the wrong mortgage product. A poor managing agent will hemorrhage your income through voids and maintenance inefficiency. Step 5 is the refurbishment and compliance process. HMOs require mandatory and additional licenses depending on your local authority. Fire safety compliance, interlinked smoke alarms, fire doors, emergency lighting in larger properties, is non-negotiable and must be built into your refurbishment budget from day one. Budget conservatively and add a 15% contingency on top. Step 6 is stabilization before refinance. Most lenders require a minimum tenancy period, typically 3 to 6 months of demonstrated rental income, before they will lend against your HMO valuation. Use this period to achieve full occupancy, document your income, and prepare for the refinance application. Now let us be genuinely honest, because any strategy presented without risk acknowledgement is not education, it is entertainment. The regulatory environment for HMOs has tightened significantly over the past 5 years and that trajectory is continuing. Article 4 directions. Local authority designations that remove permitted development rights to convert standard homes into HMOs now cover large parts of most major cities. Before you purchase, you must verify whether you are in an Article 4 area and whether planning permission for change of use is required. Fail to do this, and you may find yourself holding a property you legally cannot operate as an HMO. Refinance risk is real. If your post-refurbishment valuation comes in below expectations, which can happen if you have overcapitalized for the area, or if the market has moved, you may not be able to pull out as much capital as planned. This can stall your ability to repeat the cycle. Always model for a valuation 10 to 15% below your target figure and ensure you can still service the debt. Void periods in HMOs can be disproportionately damaging to cash flow. A single vacant room in a 6-bed property represents a 17% drop in gross income. Professional management, strong presentation, and location selection near genuine employment or education hubs are your primary defenses against this. Finally, the tax and regulatory landscape for landlords continues to evolve. Section 24 finance cost restrictions remain in place for personal ownership. Another compelling reason to operate through a limited company. Energy performance certificate requirements are moving towards a minimum Band C rating for new tenancies in the coming years, meaning older properties may require capital investment in insulation, heating systems, and glazing that must be factored into your acquisition analysis today. The journey from £0 to £50,000 in annual rental income is not a straight line, and it is not a short one, but it is a rational, achievable path for investors willing to learn the system, do the due diligence, and execute with discipline. The BRRRR strategy, applied to HMO conversions in the right UK markets, remains one of the most powerful wealth-building tools available to the private investor in 2026. It rewards knowledge over capital, patience over speed, and process over impulse. If you are serious about starting or scaling your portfolio this year, the two things I would encourage you to do right now are these.